How do you make sense of vast macroeconomic data predictors? Data are simply measurements over a specific period that to some extent tell us what has happened in that period and to another extent predict what could happen in the future. Data more helpful to predict the future are called leading indicators, while those showing past or current state of affairs are referred to as lagging indicators. Indeed, every process in, say, a chemical plant has lagging data that can be useful to confirm quality expected, while leading indicators can be important to avert future issues. The temperature in a burning kiln is both a lagging and leading indicator showing all is operationally going well, and can also be predictive of a serious problem requiring less fuel. Hello and welcome to Global Business Insights in 2025, where we educate on business concepts with experienced professionals able to bring you well-grounded thinking with current applications. Today, the focus is on the latest macroeconomic data and what it says about the 2025 outlook for business.
We also just got an upside surprise in the US as 256,000 jobs were added in December, pointing to market resilience. Unemployment rate also fell to 4.1%. But first, some of the other global business headlines. Yesterday, China's CPI was up 0.1% year-on-year in December, as expected, and after 0.2% growth in November. Month-on-month December CPI inflation came in at 0% versus November's 0.6% decline, also as expected. The producer price index or wholesale price index declined 2.3% year-on-year. Weak inflation can be a reflection of tepid growth, apart from more financial support for innovation and consumption stimulation. The Apex Bank is using new tools to help liquidity, also reaffirming commitment to lower interest rates, all to get healthier growth. Earlier on Wednesday, in the US, there were 201,000 initial jobless claims in the week ending January 4, following a previous week's print of 211,000 and better than 210,000 expected, signaling a healthy job market. But the labor market downshifted to a more modest pace of growth in December, with a significant drop in both hiring and pay gains. Private sector jobs added was up 122,000 in December, and annual pay was up 4.6% year over year. This was also lower than the 146,000 job added recorded in November. We saw activity in the U.S. services sector expanding at a faster pace in December, with the ISM services PMI up to 54.1 from 52.1 in November. Meanwhile, US S&P data showed the manufacturing PMI up to 56.8 in December from 56.1 in November, though below the flash reading of 58.5. Also in the US, job openings on the last business day of November stood at 8.09 million after the 7.83 million openings reported in October and better than 7.7 million expected. The rising yield on the 2-year US Treasury note is another leading predictor, signaling investors don't see rates going down much at all in the next couple of years, given their own reading of higher inflation than was initially thought. Germany's industrial sector rebounded in November as industrial output jumped better than expected by 1.5% month-on-month, also reversing a 1% drop in October. But year-on-year, German industrial production still fell by 2.8% year-on-year in November. Just weeks before Chancellor Scholz faces elections, November factory orders in Germany unexpectedly slumped by a steep 5.4%. That's on the month, compared to a shallower decline of 1.5% in the previous reading. Germany's
manufacturing sector remains subdued, with the latest PMI unchanged at 42.5. Also in Germany, month-on-month November retail sales fell 0.6% after dropping 1.5% in October. Meanwhile, the consumer price index rose in Germany to 2.6% on a yearly basis in December from 2.2% in November. The environment in Germany remains tough. Earlier in the week, the euro gained after later denied reports that Trump may be having a change of mind on tariffs. The European Central Bank President Christine Lagarde last week also said that the 2% inflation target is still in sight. Eurozone HCOB, that's Hamburg Bank Manufacturing PMI, revealed a slight decline in goods production, dropping to 45.1 in December from the previous reading of 45.2. Also in the Eurozone, inflation was up for a third consecutive month to reach 2.4% in December. Though much in line with the forecast, it still was an increase from a revised 2.2% print in November. Core inflation stayed at 2.7% for a fourth straight month, while services inflation inched higher to 4% from 3.9%. The data in Europe is signaling a sticky stagflation. And in the UK, the global manufacturing PMI fell to 47 in December 2024 from 48 in November, well below market expectations of 48.2. The pound extended its slide against the dollar yesterday to hit a 14-month low. On Wednesday, the UK 10-year borrowing costs rose to the highest level since the global financial crisis, sinking the sterling. The 10-year gilt yield climbed 0.13 percentage points to 4.82%, its highest level since 2008. The gilt yield is a predictive indicator of higher interest rates in the medium term and higher inflation and less fiscal space for the Chancellor, forcing more cuts to government spending, pressure to tweak taxes higher, or even to borrow more. Chancellor Reeves has been summoned by the UK Parliament to shed more light on what looks like a difficult time for the UK economy. Oil prices surged today, Brent up 3.7%, close to $80 per barrel and over a 3-month high, and on track for a third straight week of gains. Apart from rising China demand, we see a return of risk premium over potential supply disruptions from more sanctions on Russia and Iran. Nigeria's Dangote refinery is reported to be building additional tanks, targeting about 6.3 million barrels of extra capacity to store foreign crude. This is as availability of local supplies looks vulnerable, especially with the reported revival of NNPCL refineries. And also in Nigeria, key data on the economy remains inaccessible nearly 3 weeks after the nation's statistics agency shut down its website after it had been hacked. The main data released this week was the much-watched US Nonfarm payroll data, which we will get into later. Whether you need broad measures of economic performance and competitiveness to decide on a major investment, or whether you are a trader in stock markets taking daily decisions, or in your peculiar business, or if you are in a specific industry and need a suite of industry-specific performance, leading and lagging indicators that can help you track progress of your business and pre-warn of red flags, you will always need data like the dials and flashing lights on the pilot's cockpit. First, start by understanding that there are two broad types of measures and know which you are dealing with. Leading indicators predict future conditions and help you anticipate trends that could influence the economy, your industry, your competitors, and your own business or your area of focus. Lagging indicators focus on the past, that is what has already happened. They confirm predictions and can also provide pointers to the future, but usually more reflective of the current state of affairs. You need both leading and lagging indicators to keep your business on the right track. The Purchasing Managers Index, PMI, that gauges economic activity is predictive of gross domestic product, that's GDP data, and that makes it an example of a leading indicator. Another leading indicator could be the Consumer Confidence Index. Another is retail sales data, which provides early signs on consumer sentiment and future spending. Jobless claims data can also predict conditions in the labor market. Examples of lagging indicators include the gross domestic product, which tells us what business activity was like in the specific period. CPI, Consumer Price Index, is another measure that mostly lags. By the time changes in CPI are reported, they have already occurred and had their effect. In the US, the Federal Reserve uniquely tracks the Personal Consumption Expenditure Index, PCEI, which has a broader coverage than the Consumer Price Index. The PCEI also includes expenditures by third parties on behalf of consumers like employer-paid healthcare and covers both urban and rural spending. What the data means also depends on your industry. You do not need expensive subscriptions to track data. And if you use a mainstream business media that has a paid subscription website, be sure to start at the lowest price tier and upgrade as your appetite for data expands. If you're into stock trading, leading indicators are key if you don't want to lose your shirt. To recognize the overbought or oversold signals, you will need to be able to interpret an array of more technical indicators, and there's obviously training available so that you know what you're doing. There are sites like FX Street and Yahoo Finance, which are more affordable, if not free, that provide decent, no-fuss summaries, aggregating the top business news and data calendar of major market moving indicators. I think they are great for starters if you want a simple, non-technical language, especially for beginners, and allowing you to grow and progress into the pricier premium subscriptions, which offer much more technical analysis. Do you need to subscribe to expensive research reports? I would say no if you cannot afford it, especially as perspectives become outdated fairly quickly in the dynamic environment. Central bank websites, statistics bureau sites provide free and excellent interpretation on data, and the Reserve Bank governor or Fed chair or central bank governors' press conference and speeches provide forecasts and analysis. Minutes of monetary policy deliberations and tables of data are all available free on websites, and they tell you almost everything you need to know on the economic outlook. Like I said, if you're a market trader, you need to get trained on the more technical indicators and what they signal. The timing for a loan, tapping into capital markets, the timing for investing or selling a major asset can depend on the trajectory of future interest rates and macroeconomic forecasts. Of course, you need to get sound financial advice, if only to confirm your hunches about the data. In the US, job growth was stronger than expected in December, signaling less incentive for the Fed to cut interest rates this year, implying Powell is more likely to wait to see the inflation reads and Trump's first moves. Non-farm payrolls surged by 256,000 for the month, up from 212,000 in November and above the about 160,000 forecasted. October and November's numbers were revised lower by about 8,000 jobs. The unemployment rate edged down to 4.1% from the 4.2%, while the labor force participation remained steady at 62.5%. The annual wage inflation, that is change in the average hourly earnings, declined to 3.9% from 4%. Also good news for the inflation trajectory. As the data was released, dollar strengthened, treasury yields spiked and the Dow sank, suggesting the Fed will pause rate cuts for a while. The focus will now be on next Wednesday's December CPI read to interpret what this means for the Fed's interest rate path. Shares mostly down in Asia after US markets were closed yesterday to observe a national day of mourning for former President Jimmy Carter. Well, that's all we have on today's episode of Global Business Insights. Thank you so very much for watching and following the channel. This is Bode Oshosami. Bye-bye.